But the big question is, what happens next if another financial institution runs into trouble?
So the US money supply is now shrinking for the first time since the Great Depression all the way back in the 1930s, and the internet is buzzing all about it. And while all of that is happening, another major bank is on the brink of collapse, First Republic Bank.
California-based First Republic Bank was given a $30 billion lifeline from 11 other banks.
11 of America's largest financial institutions agreed to pump $30 billion into First Republic.
The bank also reports depositors pulled out more than $100 billion out of the bank, believing that First Republic could be the third bank to collapse after Silicon Valley Bank and Signature Bank in New York.
Here's some context, by the way. When Silicon Valley Bank failed, it was the 16th biggest bank and the second biggest to ever fail, right behind Washington Mutual, which had $188 billion in deposits. Now, First Republic was the 14th biggest bank in the US, with over $200 billion worth of deposits at the end of 2022. And once people saw the collapse of Silicon Valley Bank, a lot of them got scared and decided to pull their money out, and that's why over $100 billion worth of deposits left First Republic. And because of that, 11 of the biggest US banks decided to step in and give $30 billion to First Republic to try to stabilize them. And now First Republic's stock price is collapsing.
The stock slumped 50% yesterday after it reported a dramatic $100 billion worth of withdrawals in the last quarter.
The stock has now lost over 50% this week alone, and on Wednesday, the stock was halted multiple times throughout the day because of how volatile it was. But the craziest part about all this is that someone actually predicted this could happen. Jim Cramer, who said that First Republic was a good bank. So if you saw that tweet, you probably knew to short the stock because usually the opposite happens, which is also why the stock has lost over 90% of its value since that tweet. But don't worry if you missed out on making dollars, because we might not need those soon. Apparently the yuan has overtaken the US dollar to become the most used currency in its cross-border transactions for the first time in history. And now Jim Cramer is telling us that there's no systemic risk in the banking system.
However, there's one big difference between now and 2008. This time there is no systemic contagion. Now, I know that seems hard to believe, but there isn't. It's a miserable moment for First Republic, once a bank beloved by the rich and famous. But it's an all-clear event for everyone else.
So translation, we're all doomed. Jokes aside, in today's video, I want to help explain exactly what's going on in the banking space. I want to make sense of all the madness between the US dollar and the yuan. I want to give you a quick update on some crypto stuff, and then I want to share with you how I'm personally investing. So with that said, let's get into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for another episode of how I'm going to creatively tie this video back into low-cost broad market index fund investing. So here's a quick recap of why all of this is happening, starting with the banks. Let's say a hypothetical bank gets $2 billion in customer deposits. It might invest half of that into treasury bonds to earn some interest, and the other half it'll give out as a loan. Now, when interest rates go up, like they are right now, those bonds become worth less because new bonds are paying a higher interest rate and more people want them. That's why the value of the older bonds the banks bought go down. And when a bank has less on paper in deposits than it should, if enough people ask for their money back, they become insolvent and they need a bailout. But right now the government is telling everyone that they don't want to bail out First Republic, and that's why their stock price is crashing. But while all of this is happening, people are talking about something else. The US money supply, which is going down, and here's what that means. When it comes to stocks, investors always look forward to the earnings season. Now, if you're not sure what earnings season is, it is easily one of the busiest times for those who watch the markets. And that's because that's when a company tells their shareholders exactly what's happening right now and where they think they're going in the future. It's extremely valuable, but there's a problem. Sometimes earnings calls can last for hours, and you can miss them if you don't know when they happen or if you just don't have the time to sit through them. And that's why I'm so excited about Moomoo. Moomoo is a one-stop trading platform for US stocks and the global markets. Moomoo offers pro tools without pro prices. Tools like Moomoo's Smart Earnings Calendar, which you can easily access by clicking Markets at the bottom of the app, click Explore, and then you'll see the Earnings Hub. Once you click on that, you'll be able to see that they already published several reports from previous earnings calls. So for example, if we click on Netflix, you'll see that it gives me a summary of everything I need to know, which gives me valuable insight into potential future investment opportunities. And if you scroll a little lower, you'll also be able to compare the stock with peer companies, see important Q&As directly from the conference, and even see opinions from financial experts on the stock, or as they're called, Mooer's opinions. Now, Mooer's features are completely free to use, and there are no hidden charges or fees. But the best part is that new US users can get up to 15 free stocks when they deposit $1,000 and new Australian users can get up to 10 free stocks when they deposit $2,000. But don't forget to click the link below in the description of this video because the offer expires on April 30th. So don't forget to check them out. Let me know how you like them. Thank you, Moomoo, for sponsoring this segment of the video, and now let's get back to it. Now, you might have seen this really scary chart, which shows what's called the M2 supply of money, which is shrinking for the first time in almost 100 years. Now, the last time that's happened was during the 1929 Great Depression and the times before then, during the Panic of 1893 and the banking crisis of the 1870s, and it all sounds terrifying. But before you panic and pull all your money out, there's actually a really simple explanation for this because it's happened in the past.
In 1971, the quantity of money started to grow more rapidly. As always happens, inflation wasn't affected for a time. But by late 1972, it started to respond. In early 73, the government reacted. It started to cut monetary growth, but inflation continued to soar for a time. The delayed reaction made 1973 a very tough year of recession. Inflation tumbled only when the government demonstrated its determination to keep monetary growth in check. It took 5 years to squeeze inflation out of the system.
That was Milton Friedman, who's one of the world's most respected economists, explaining inflation and monetary policy in Japan. But this happens during every recession when a government usually floods the economy with money like we did with the pandemic. We got inflation, and now we're draining the economy of money, we're taking the liquidity out, and now we're seeing the effects of disinflation. And that's why we're seeing this scary chart of the money supply going down. But the real chart we should be looking at is actually this one. The red line shows the rate of creating money is now negative because we're draining it out of the system. But the blue line shows we're still way above where we should be on the average trend line. So all in all, there's still a ton of money in the system and we still have high inflation, and the Fed is trying to take the liquidity out. And when there's less liquidity, the traditional rule is that asset values grow a lot slower, which makes sense. It's kind of like watering a plant. When you have less water, the plant will grow a little slower. In this case, water is money, and the plant is all of the stuff we invest in. Makes sense. Now, we could get another Great Depression, but as far as that chart is concerned, it's not predicting a Great Depression, so don't let it scare you. And also, don't let anyone scare you with the yuan and the dollar, because here's what's happening. You might have seen this story about the yuan taking over the dollar for China's cross-border payments, and that even countries like Argentina are forging partnerships to pay with yuan instead of dollars. You might have also seen this statistic that the yuan was used in 48.4% of all the cross-border transactions, while the dollar's share declined to 46.7%. Now, when the average person hears that, assuming they don't watch my YouTube videos every single week, that sounds terrifying. People would assume the worst, but that's not exactly true. Yes, it's true, the yuan is growing in popularity, and China is making partnerships with other countries, and the BRICS nations do pose a threat to the US dollar's dominance in the future. And it's also true that the Chinese yuan is the #1 currency for cross-border payments for China. But the real truth is that the Chinese yuan still represents a small percent of the world's total use of it. According to Swift data, in March this year, the yuan accounted for only 4.5% of all the global commerce, in comparison to 83.71% for the US dollar. So for now, the US dollar is still by far and away the dominant world reserve currency, but yes, it's slowly shifting and it's definitely something to pay attention to. Another thing to pay attention to, though, is the SEC and crypto.
Crypto markets suffer from a lack of regulatory compliance. It's not a lack of regulatory clarity. If you make securities available to American investors, you must comply with American laws.
The main problem is that the SEC and the DOJ is making it very hard for those exchanges, and a good example is Binance, which was blocked from buying Voyager. This was supposed to happen, but after months and months of legal battles in court, it looks like Binance is backing out of buying Voyager, citing that the US government is just too hostile. Which is really unfortunate because a lot of us had our crypto in Voyager, including myself, and we were really looking forward to getting some of our money back, but now it looks like we're just going to be left wondering exactly what happens next. Expectations say that anywhere between 40 to 65% of our value could be recovered, but that's only if the US government allows it, and for now, They're just draining customer funds with their legal battles. That's really unfortunate because all it's doing is it's punishing US customers and it's pushing innovation overseas. And that's really bad for everyone because that means less protections in case of bankruptcies in the future. So that's the crypto space, and here's how I'm personally investing. Now here's exactly why I don't listen to stock recommendations, I don't look at price charts, I don't read stock ratings or analyst ratings, because no matter how qualified or certified a person is, no one knows where a stock is gonna go. And if someone gets it right, it's because statistically someone has to. But notice how it's never the same person more than once. And here's another reminder of how this happens every single day.
Scott, I'm not trying to be a hero here at all, okay? What I do, and you know this, is I analyze companies, I look at their financial statements. And I'm going to tell you right now that First Republic, as a representative of the regional banks, but also the regional bank that has the crosshairs on it right now, is a good bank. This is not a bank in trouble. This is a bank that is now meaningfully undervalued, and I think representative of the regional bank index in general. Last thing on this, I've never actually owned a regional bank. This is my first foray.
That was just a month ago in March when professional analysts came on CNBC to talk about how First Republic was fundamentally undervalued. And you know what? It might have been, but no one knows where the future of a stock is going based on looking at data from the past. That's why I personally continue to dollar cost average and reinvest into ETFs like VOO and VTI, because with this one stock, I can own several thousand stocks inside of it, and I don't have to do anything, because if one of those companies falls away and doesn't meet the criteria to be inside the ETF, it automatically gets booted and replaced with something that's better. And I don't have to pay attention to any of it, it just does what it does, and I will beat over 90% of professional investors that will come on CNBC to give their opinion about a stock. Now, there's nothing wrong with picking individual stocks if that's what you want to do. I still do that from time to time with blue chip dividends for passive income, but even with that strategy, I try to stick with broad market ETFs because I have no idea where one company will be in the future, but I am betting that 20 to 30 years from now, the US economy will be bigger and be doing better than where it's at right now. But in the meantime, I hope you focus on your own investment journey so you can get your own financial independence, ignore the noise, and I hope you have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Don't forget to grab your free stocks, links are down below, and then go track them automatically with the spreadsheet link down below in my Patreon. Love you, thank you so much for watching this video. I'd love to see you back here on Monday, Friday, sometimes a Wednesday. See you soon, bye-bye.